Okay, let's just kick things off with a bombshell. Now, this isn't a quote from some random critic with an axe to grind. This is from Eugene Fama and Kenneth French, two absolute giants of modern finance, talking about one of the most famous Nobel Prize-winning theories in their entire field. So what on earth are they talking about?
Well, they're talking about the Capital Asset Pricing Model, or CAPM for short. You've probably heard of it. For decades, this thing has been the crown jewel of MBA programs and a go-to tool on Wall Street. But as you can probably guess from that opening quote, the story of CAPM is really about a brilliant, beautiful idea that ran headfirst into the brick wall of messy reality. So let's dive into that collision.
To really get why this theory completely took over the world of finance, we first have to appreciate just how elegant and simple it was. I mean, it promised to answer one of the most fundamental questions out there. How do you put a price tag on risk?
So, this thing pops up back in the 1960s from the work of William Sharpe and John Littner, and it offered this incredibly clear, powerful, and honestly just intuitive prediction about how risk and expected return are connected. It was a massive breakthrough.
Now, this model didn't just appear out of thin air, right? It was really the next logical step after Harry Markowitz's groundbreaking work on portfolio theory. You know, the idea that investors want the most bang for their buck, the highest return for the least amount of risk. Sharpe and Littner took that, added a couple of pretty big, you might even say wild, assumptions, and boom, out came this simple, powerful equation that said an asset's expected return really only depends on one thing, and that one thing is called beta.
Beta is the beating heart of the CAPM. The best way to think about it is like a stock's economic Richter scale, right? If the whole market is an earthquake, beta tells you how much your specific stock is going to shake. A beta of 1, you're moving right along with the market. A beta of 2, whoa, hold on tight, you're in for a much wilder ride. It was incredible. All the complicated, unique risks of a company could seemingly be boiled down to this one single number.
But of course, any interesting model has to make some unrealistic simplifications. Which brings us to the next big question. How does this beautiful theory actually hold up when you test it against real-world data? It's time to put the theory on trial. And at first, things look pretty good. You know, researchers like Fama and Macbeth did a famous study back in '73, and they found that, yeah, generally speaking, stocks with higher betas did tend to have higher average returns. It seemed like the theory was on the right track. Now, here's the crucial catch. While the relationship was there, it was a lot flatter than the model said it should be. Low-risk stocks were actually doing better than predicted, and high-risk stocks were doing worse. But, you know what? At the time, that was good enough. It kind of fit with a slightly tweaked version of the model, and so CAPM got the stamp of approval and became a fixture in textbooks and boardrooms.
But the story doesn't end there, not even close. As researchers got their hands on more data and better computers, they started to spot these weird patterns, these anomalies that the simple elegance of CAPM just couldn't explain. The foundation was starting to show some serious cracks.
The first major blow came in 1981. A researcher named Rolf Banz uncovered what we now call the size effect. Basically, he found that historically, smaller companies were consistently earning way higher returns than their betas said they should. Now, this wasn't just some academic curiosity. This suggested there was a way to systematically beat the market that the theory said was impossible.
And then bam, another one hit. Researchers found that so-called value stocks, you know, the unloved bargain bin companies that look cheap compared to their assets, were also consistently outperforming what CAPM predicted. This was another huge problem, another pattern the model was completely blind to.
So the evidence was just piling up. It seemed like things like a company's size or how cheap it was held really powerful clues about its future returns. Clues that beta was totally missing. The beautiful simplicity of the theory was just getting shredded by the messy complexity of the real market.
And if you need to see just how badly the theory breaks down, look no further than this table. It's absolutely stunning. Look at value stocks. They had a lower beta, meaning they were supposedly less risky than growth stocks. So according to CAPM, they should have had a lower return. But what actually happened? They returned a staggering 16.7%, just blowing away the growth stocks. This is the literal opposite of what the theory predicts. It's not just a little off, it's completely backward.
So this total failure left the entire finance world scratching its head. If beta isn't the whole story, then what is? This massive puzzle split the academic community down the middle, leading to one of the biggest debates in modern finance.
So on one side, you have the rational risk story. This camp basically says, look, the CAPM isn't wrong, it's just incomplete. Small stocks and value stocks aren't outperforming because of magic, they're just riskier in ways that beta doesn't capture, and investors are being paid to take on that extra hidden risk. Then you've got the other side, the behavioral finance camp. They say, nope, the model's fine. It's people who are the problem. They argue investors are irrational, they get way too hyped about flashy growth stocks pushing their prices up too high, and they're too down on boring value stocks pushing their prices too low. The outperformance is just the market slowly correcting these emotional mistakes.
Out of that rational risk camp came a practical solution. Fama and French essentially said, okay, if the one-factor model is broken, let's just build a better one. They kept the original market beta, but they added 2 new factors to capture those size and value effects we saw. And this new 3-factor model was a huge leap forward. It explained the historical data much, much better. The only knock against it? It was built by looking backwards at the data, not from some pure, elegant theory.
Okay, so you might be thinking, the old model is busted, there's a new, better model, so why are we even still talking about this? Why should any of this matter to you today?
Because, and this is the truly wild part, despite all the evidence we just went through, the original, simple, and yes, broken CAPM refuses to die. It is still a super common tool used by huge corporations and Wall Street analysts every single day.
And this is genuinely dangerous. Using a tool that you know is flawed leads to really bad, really expensive mistakes. A company might wrongly pass on a great project because the model gives them a bad number. Or even worse, you get a fund manager who just loads up on value stocks, and suddenly they look like the next Warren Buffett with amazing alpha, when all they're really doing is exploiting a known flaw in the measuring stick. The bottom line is what Fama and French said. If it doesn't work in tests, it doesn't work in the real world.
So why do we still teach it? Why is it the first thing you learn in Finance 101? Well, because, as even its sharpest critics admit, as a theoretical idea, it is an absolute masterpiece. It's the perfect first step to understanding that deep, fundamental connection between risk and return. It beautifully introduces the concepts that risk can be measured and that investors should only get paid for taking on the kind of risk they can't just diversify away.
Ultimately, the story of the CAPM is so much more than a finance lesson. It's a fascinating, cautionary tale about the limits of our economic models. It shows how a beautiful, simple theory can be incredibly powerful for shaping how we think, even when it completely fails to describe our messy, complicated reality. And that just perfectly captures this ongoing battle between our elegant theories and the stubborn, undeniable facts of the real world.